lot of folks who start with this strategy are young, right? Like from right out of college, in their first jobs, and sometimes they have high debt liability. They have student loans, college loans, and stuff. So, what would be your advice to such investors? Like, should they clear up the debt liability first? Should they start creating long-term wealth-generating instrument? How? What would your advice to be for somebody who's already carrying a debt liability but wants to retire very early?
Sure. Thanks, Arshil, for moderating this. It's a really good company. See, on retirement and loan, I see the loan, most of the loans as an investment sometimes, like while people keep saying that, you just loan is dangerous, should not have loan. But I think, Pasna was mentioning buying house, like somebody taking a loan for a house, it's a humongous loan, but then it's an investment which will give you a comfort, confidence, and an asset that you can feel retired from a need of working to earn money. And even people take education loans, right? So paying off that loan is upgrading you, right? You'll be your income, your earning capabilities are going to go up, and your savings will naturally go up, and you'll have more money to invest. So loans need to be treated in what those loans are for, and if that's planning in a way that helps you earn, save, invest more in the future, that also is a good strategy. Not that every loan will be like that, not that every spend will be like that, not that every investment will lead you to the right place where you can be retired early. But having said that, it's a very again, it may sound like a gyan, but then it's a very simple strategy. You start early, you do it regularly, and you keep increasing the amount. And if you keep doing this for long, you'll feel comfortable. It may be 38, 30, 40, 45. It's the age may be different for different people. It may be a different amount for everyone. But I think it's more of the confidence and the comfort that, hey, now I know that I don't need to really work for money. I have enough money, or I have enough saving, or I have enough sources and assets where I can get my future financial needs from. And now I can do something that I want to do. It may be rest, or it may be some entrepreneurial journey, or it may be something that you want to pursue as a hobby. So that's the retirement for me.
Oh, interesting. So basically, you're saying like you don't need to completely stay away from debt. Like you have to plan it well, but like even with debt, you could still go through the fire strategy. That is interesting. I think I'll go back to like something that Upasna said, right? Like when I was young as well, I used to think that, hey, once you get 1 crore of rupees, then you at that point of time the interest rates are 10% and you get like 10 lakh a year. That is enough for you to survive. Like why do you need to ever do a job again in your life? Of course, as you grow up, you realize that things are far more complex, and of course, interest rates have been falling. So in the current environment, and I'll pose this to Nikhil, given that you have been a trader yourself, right? In the current environment, what could be the investment instruments that somebody could look at for executing this? Like, should they go with FDs, real estate, stocks, direct equity? Like, what would be your strategy for something like this?
So, Harshal, at the current juncture, I think a case can be made to remove leverage. Every asset class, from private equity to public equity to real estate, everything seems overinflated and frothy today. People are, when I sometimes see some of the valuations of today, manufacturing companies trading at 130 times, or chemical companies trading at 50 times, things are a bit too overheated, and a lot of people are coming into the equity ecosystem in the last 1 or 2 years. I would, in fact, like to, recommend some amount of caution and diversification out of risky assets such as equity and real estate and what was the other thing you spoke about? Private equity. I would, in fact, recommend you build a more diversified portfolio and people get some exposure to things like fixed income instruments where the amount of risk is much lesser than any of these riskier asset classes.